to the Capital Stack Podcast, brought to you by the BWE's Arizona Team, bringing you the latest capital market and lender news for commercial real estate. I'm your host, Ryan Denchev. And now for the latest market news for the week of May 16th. A wave of risk aversion has pummeled financial markets since the Federal Reserve decided to increase interest rates by 0.5% 2 weeks ago. This was the largest rate hike since 2000, and it was made in addition to outlining a plan to begin unwinding its $9 trillion balance sheet. For the first time in 8 months, the broader annual reading on consumer prices moderated. The annual rate of inflation has risen sharply since early 2021 when the U.S. economy's rebound from the COVID-19 pandemic accelerated, leading to labor shortages, supply disruptions, and other market imbalances, which have put upward pressure on prices. The broader monthly consumer price index rose 0.3% in April and 8.3% on an annual basis, still lingering among the highest readings in decades. The benchmark 10-year Treasury began 2022 at 1.5% and is currently at 2.88%. Since the start of the second quarter, the 10-year Treasury has seen an increase of over 60 basis points. The 2-year Treasury, more sensitive to the near-term outlook for interest rates set by the Fed, jumped to 2.645% from a mere 0.73% in January. Now let's jump into the latest up-to-date lender news. Kicking things off, life companies have reported mixed feedback this week in quoting and closed business, as some lenders have been pushing hard to fill their allocations, while others have slowed significantly after impressive first quarters. Spreads have increased for attractive lower leverage loans, 60 to 65% loan to value, by approximately 5 to 10 basis points to a range from 1.6 to 1.9%. Life company construction to permanent financing continues to be a product in high demand for borrowers. The ability to lock rate for the entire term of the financing, including both the construction and permanent phases of the project, is very desirable in this increasing interest rate environment. Life companies view construction perm loans as forward fixed rate perm loans, and the higher spread for these loans has historically been tied to the forward rates to get to the permanent phase of the project. Today, forward commitments and construction perms are becoming difficult to price due to volatility in the capital markets, expectations of inflation, and fluid Fed policy going forward. Switching over to the agencies. The agencies have held steady with allocations due to their pricing reductions that were rolled out earlier this month. Fannie and Freddie continue to adjust approaches to win business to keep their mission-driven and affordable housing goals within reach. For example, they're willing to provide partial to full-term interest-only payment structures on loans that are lower leverage with 50 to 55% loan-to-value and debt service coverage ratio of 1.25. This week, the agencies provided pricing reductions for sub-$6 million loans to increase their deal flow for 5 to 50 unit properties. These price reductions have resulted in similar pricing for deals above and below $6 million. In the past, smaller size loans and higher spreads were pricey to execute. Shifting to the latest for the U.S. Department of Housing and Urban Development. HUD provides new construction loans with potentially less long-term risk. Given the current volatile interest rate environment and construction delays, some of our clients that were moving towards a conventional construction loan have decided to change direction into a HUD 221D4 due to the ability to remove many of the uncertainties of building multifamily projects in this financial climate. With the interest rates increasing, the queue in HUD is shrinking. This new construction loan can usually process in 9 to 12 months and rate lock following the firm commitment. This allows for the borrower to secure fixed-rate IO during construction with interest expense included in the loan and automatically convert to a 40-year fully amortizing loan on completion of construction. The decision is to rate lock a 40-year fully amortizing non-recourse loan in 9 to 12 months or refinance into a permanent loan following construction completion in 2 to 3 years. So now is a great time to refinance your construction loan into a HUD FHA 223F with a fixed rate 35-year fully amortizing non-recourse loan at 85% loan to value or 80% loan to value with cash out. Reach out to our Arizona HUD team for more info. So now let's round out this week's lender news with commercial-backed securities. The market volatility has significantly impacted CMBS and has created a slowdown for lenders due to the market conditions. Lenders are quoting on top-tier product in the marketplace like Class A multifamily. However, they're having difficulty competing with the life companies and agencies. Currently, all-in rates are approximately 4.75 to 5% for lower leverage multifamily, and retail and office deals are pricing above 5%. Everyone is watching the securitization market closely for price discovery in the coming weeks. So here's your quick market recap for the week. Life companies have reported mixed feedback this week in quoting and closed business as spreads have increased for attractive lower leverage loans by approximately 5 to 10 basis points to a range from 1.6 to 1.9%. The agencies provided pricing reductions for sub $6 million loans to increase their deal flow for 5 to 50 unit properties. These price reductions have resulted in similar pricing for deals above and below $6 million. HUD is providing borrowers attractive construction loan programs with potentially less long-term risk. The HUD 221D4 program can remove many of the uncertainties of building multifamily projects in this financial climate. That wraps up this week's Capital Stack podcast. For more information on what was discussed during this episode, reach out to BWE's Arizona Team. Contact information provided in the description of this episode and also found on our website, bwe.com.